Welcome back. Now, as I mentioned a little earlier, Kenya's biggest lender by assets, Kenya Commercial Bank, has announced its intention to acquire the country's struggling state-owned bank, National Bank of Kenya, and that's through a share swap. Now, if successful, the merger of the two listed lenders is expected to create a larger financial service sector player in the region. Well, let's break down the details of this acquisition with George Bodo. He's a director at Carl Street, and he's joining us in the studio right now. Very welcome, Mr. Bodo.
Thank you.
Now, given that the National Bank of Kenya, it has almost 400 million US dollars in bad debts, and of course, KCB could be required to inject billions of shillings into the bank or into the troubled lender. It could take some time before, of course, KCB sees those benefits of this acquisition. Some people say about 4 years. So what's your take? What are your thoughts on the acquisition and certainly its impact on KCB's bottom line?
I've got three thoughts. The first thing is that this transaction entrenches KCB as a resolution vehicle. This is the second bank that KCB, a struggling bank that KCB, really not struggling, a troubled bank that KCB is taking over. The first being Imperial Bank. And it entrenches KCB as a resolution vehicle. And I think they will play that role probably in the near future. This is not the last transaction they have. I still see them onboarding more troubled assets. The second issue is that there's a financial stability to this aspect. National Bank, for some time, has been undercapitalized, has been operating on very weak balance sheets, and this transaction, in my assessment, is going to reinforce the there's a financial stability aspect to it, because when you operate in a situation where there's a number of banks are distressed from a capital adequacy perspective, there's an element of confidence, and we saw that with Spire Bank. There was about 2 weeks ago, there's a lot of story around Spire Bank. How can Spire Bank continue operating with such dire capital adequacy issues? Yeah, there's an element, you see people asking tough questions, then where's regulation, you know? So such transaction help to entrench financial dominance.
You called it a resolution.
As a resolution vehicle.
Resolution vehicle.
Yes.
And of course, I think KCB is going to, it may acquire two other struggling banks.
So this is the second bank they're acquiring, actually. So, and I'm saying I don't see this as the last bank they're taking over.
Yeah. So it might acquire. I know I read that it might acquire two other struggling banks in Kenya. I'm not so sure about that news.
That's a matter of speculation, but for now we know that they've made an intention to acquire all issued online shares in National Bank of Kenya. And this is just to add that this is a transaction that didn't happen this year. It's a transaction that has been on the cards since 2015. It's just that because NBK is owned by NSSF and Treasury, there was a lot of friction and locking of horns over the details of the transaction. Some of them from the press release appear to have been hammered out.
Right.
Yeah.
But what does this mean for KCB's shareholders? Does the bank have enough capital? Because it's also expanding across Africa as well. Does it have enough capital to support taking on these lenders and its expansion?
I don't think it requires recapitalization, and I say this for a number of reasons. One is that there's no cash consideration in this transaction. It's a share swap. For every 10 shares of NBK, they're getting 1 share of KCB. So there's no cash consideration. The second issue is that NBK and KCB are almost like cousins. There's a lot of similarity. They have similar love story. They're all state-owned, the majority state-owned. They suffer from similar issues, actually. And I think most of their non-performing assets, if you're to unravel, you'll find that there's a linkage to the government.
Really?
Yes.
Okay.
And KCB is an expert in dealing with bad debts from the government. So I don't see, and that's the second. The final one is around NBK's assets. NBK still owns assets that can be sold. Actually, for instance, I think they own most of the branches. They own them in their books. Some of these assets can be sold to recapitalize the bank. So I don't think the bank, KCB, as the acquirer, needs to inject additional capital on this. Yeah.
Well, on that note, what are your thoughts on KCB's efforts to grow its regional footprint so far? It's talked about the Democratic Republic of Congo. It's talked about Somalia, for example. Now, especially looking at the environment in the banking sector and its bottom line.
I'll be very cautious about regional expansion because Some of the countries they've gone in, I doubt they've returned the capital. And I'm talking point in case countries like Tanzania, countries like South Sudan, which is really burnt capital for some of the banks who are there. I would be very cautious that I would urge that they be cautious in the regional expansion going forward. They've got to be very careful because most of the economies within this region are going through a synchronized slowdown, and we've seen that if, for instance, if you look at the issue of loan non-performance, it's synchronized a lot. It plays out the similar pattern across the region. So there's some level of synchron in terms of economic slowdown. So I think they would be very careful. I would be very careful. They need to state what they're going to do there, and it needs to come out very clearly, the in-country strategy. But overall, I'll urge caution on that, on the regional strategy, expansion.
Okay, we'll certainly be watching that. But let's talk about the overall banking sector. In Kenya, it's been quite an eventful year or a couple of years for the banking sector. Interest rate caps impacting their bottom lines, a spate of M&As, as we mentioned, taking place. What is your general outlook for the banking sector, especially looking at how interest rate caps have affected their balance sheets?
I'm extremely bearish on the banking sector for the simple reason that, well, two reasons. One is that the banks have failed to adapt the rate caps. You know, it's been evident that this thing is here to stay. So it's a question of can you live around it? And they've refused to live around it. We have banks who explicitly stated that they're not going to lend, they're going to buy treasury bills and bonds. That's a bad one. If a bank, one of the biggest banks coming up and says, oh, because of the rate cap, you're not going to lend. That's not a very, very, very encouraging strategy. And I think I'm very bearish on the basis that they have refused to adapt. Now, the second issue that we have a very aggressive fiscal situation on the government side that has emasculated the rate cap. When you have a situation where the government is borrowing domestically at close to 13%, and the rate cap is at 13%, then you basically disincentivize the banking sector to lend the economy. Yeah. So I'm very bearish on those 2 points.
Now, we're actually running out, but very quickly, what's your outlook for the rate cap? Because I think the banking sector seems quite mum on that issue right now.
I think they need to forget about it. This thing is here to stay.
Right.
Parliament has refused to comment. They're not going to budge on the court order. So I still see this thing being around.
Right.
Yeah.
Well, many thanks for joining us in the studio, and many thanks for your insights. Of course, that was Mr. George Bodo. He is a director at Call Street.